Welcome to Sravz technical series. In today's session, we will discuss the leveraged funds analysis. In the previous sessions, we discussed the ticker plant creation, historical ticker plant. There we created Rust-based historical ticker plant. And then after the fifth session, I mentioned we'll use the historical ticker to perform leveraged funds analysis. So today we will discuss the leveraged funds. So the leveraged funds is in the analytics section, in the leveraged fund section here. So today we'll discuss the screens which will show the leveraged funds analysis. I'll quickly show them how to access the links via the UI. And also I deployed the leveraged funds analysis to the UI, as I mentioned in the last session. So this is the leveraged funds screen. You can access it by going to the analytics page, leveraged funds. Once you click on the leveraged funds, it will show the portfolios. Leveraged funds will start with the leveraged funds hyphen Nasdaq. In this case, we are analyzing the Nasdaq leveraged funds. Click on that, and then it will show the fund screen. So I'll go through this section analysis. Then I'll also go through the code base. So the first graph shows the leveraged funds adjusted closing price of QQQ, QLD, and TQQ. These are the Nasdaq leveraged funds. QQQ is no leverage. QLD is 2 times of QQQ, and TQQ is 3 times of QQQ. So it's 3 times leveraged. Since it's a leveraged fund, if you look at the adjusted close price, it's just the price. So it's just no relation among them. So the adjusted close price for QQQ is at this point as of 2024, and for TQQ and QLD it's at this point. Now the leverage funds adjusted close daily returns. So we calculate the daily return. We use the pandas daily returns plot. So we take the percentage change per column using pandas. That's how we get the daily returns. I plotted the daily returns, and as expected, TQQ daily returns overshadow the rest of the returns, so we cannot see them. So we only see TQQ plot. The other two are hidden behind this TQQ plot. Now we go to the leveraged funds cumulative returns. The cumulative returns of TQQ is 3 times of QQQ, and QLD is 2 times. So if we look at the plot, we will have when TQQ is here, cumulative returns is much higher because we compound. Since it's a compound returns, every day TQQ returns 3 times of QQQ. So if you take the cumulative effect, it's much higher than QQQ. And that analysis is done using cumulative returns. We calculate cumulative returns by doing cumulative prod -1 on daily returns. And that's how we got that plot, cumulative returns plot. Then we do adjusted close daily factor return. So for example, if QQQ return is this, and then since it's daily returns and QLD is 2 times leveraged over QQQ, it should have twice the returns of QQQ. So on an average, it's at 2, and TQQ on an average is at 3, but due to volatility, it goes around the 3, and QLD goes around the 2 line. It shows that over 10 years, the return is close to 3, but not exactly 3. So that's why we won't see the exact 3 times the return of QQQ, and that's because of volatility. To calculate the daily return factor, I took the daily returns of one of the asset divided by the daily returns of the QQQ, which is the base ETF, no leveraged ETF. So it's just the division of daily return of each ETF by QQQ daily return. Now we see the daily return beta slippage. Beta is calculated by taking the cumulative returns of the each ETF minus leverage factor of each of the ETF times the cumulative return of that of the base ETF. Base ETF in our case is QQQ, and the leverage factor is set here. Leverage factor of QQQ is 1, QLD is 2, TQQ is 3. Based on that leverage, we calculate the beta slippage. Now, the beta slippage will show how effective the portfolio is. If it's a positive slippage, that means we are making return on the asset. If it is negative, that means we are losing money on the asset. In our case, since QQQ has gone up, it was in context in last 10 years. We see that QLD has gone up too, but beta has dropped here. Even here, the beta slippage is very high. It slipped a lot. Whenever QLD falls, we see large drop in the beta. Drop in beta implies that though we have taken, due to our leverage, we're losing more money in the leverage ETF compared to the base ETF. I'll go to the returns plot. So if you see here, during big drop in the asset, we see a major drop in the beta. Beta slippage is higher. And the more volatility in the beta slippage, the lesser returns we would get from the leveraged fund. So we also took the leveraged fund 30-day rolling volatility, and as expected, the volatility of TQQ is 3 times of QQQ. So the higher the volatility, the beta slippage is high. So when the volatility goes up, market at least in this ETF's case, when there's a high volatility, we have seen large drops in the asset prices. Recently, the volatility is not that high. It's a relatively calmer period, so we have seen an extensive amount of QQQ trades. The QQQ has gone up really high with low volatility. But once the volatility jumps, like for example in this case, when the volatility jumped here, the price has fallen. Price has fallen drastically. So volatility has always gone up. Say for example here, we don't see the price effect. It's a small drop because the QQQ was very low priced asset at that time. The moment the volatility goes up, there's a high beta slippage. We calculated the rolling volatility using this formula, using pandas. 30-day rolling volatility is rolling window 30 standard deviation. That's how we took daily returns volatility standard deviation. Then we took the daily returns using describe. We got the summary statistics. For example, this is QLD, QQQ, TQQ. The same number of observations. The mean is around the same, 0.1, 0.1, it's 0.2. Standard deviation is around 3 times. If QQQ standard deviation is 13, 0.013. TQQ standard deviation is 3 times, of close to 3 times, 0.039, 0.026, so which is really close. 2 times the leverage. The more the leverage, more the standard deviation. The min is also the same, minus 0.12, 2 times of that, 3 times. Similarly, the max and price. This is daily return max. When this return 0.85 on a day, this return 3 times, close to 3 times of it, and this is 2 times of it. It's a single point observation, matches the leveraged amount. Then leveraged funds adjusted rolling standard deviation. It again shows that the standard deviation is 3 times per the leverage. For example, this is QQQ, green is QLD, and the yellow is TQ. It's almost the rolling standard deviation is as on. Once we smoothen it out, it is close to 3 times. So the higher the volatility, there is a more risk of losing the original principal. Analyzed conditional volatility based on GARCH model is analyzed conditional volatility. We'll cover the GARCH model in a separate video. For now, we have the plot, and this also shows that the volatility for TQQ is 3 times of QLD. Switch to the next plot. We'll go to the documentation. We did the leveraged funds returns analysis. We discussed this. Now we'll discuss the tier sheets equal weighted leveraged funds, equal weighted portfolio, and leveraged funds, equal weighted, and non-leveraged fund base fund QQQ analysis. So to do the portfolio analysis, we have to go to this page. We'll do the returns analysis of the base ETF, which is QQQ, and the portfolio of the three assets. We can go to the portfolios page from here. We can go to the portfolios page by clicking on this hamburger icon, then data, portfolios. Once you click on that, you will see that leveraged funds. We pick this first fund. The first fund has these assets in them: QLD, QQQ, TQQ. I added equal weights to them, so same amount of money will go into those funds. So for example, the fund is has a notional value of $100. So we put $33 in QLD, 33 in QQQ, and 33.33 in TQQ. 0.1 extra to QQQ. All these three have the same weightage. So if we multiply the weightage times the leverage, then the portfolio will be two times the amount in QQQ compared to just the base QQQ. Since QLD is $33 into 2 because of leverage, it's $66. Then you have $33 in QQQ, so these two together will be $100. And this is 33.33 into 3, which is close to $100. So in all, you have two times the exposure to QQQ compared to just one single asset, which is in one single ETF, the base QQQ. So now if we look at the returns tier sheet, the annual returns for just QQQ in last 10 years was 18.046, whereas for the portfolio, we have 29.61. So since it's the double the leverage, it should have been close to 36%, but it is not close to 36%, it's just 30%. The extra 6% is lost because of the volatility. Now the annual volatility is 21%. Since we have two times the leverage, the annual volatility is 41%. Because of this extra volatility, we don't get the exact two times the return we would have otherwise gotten. So over the long term, you would never get the amount of the return which is proportional to the amount of leverage that is put in the ETF. We'll skip these other ratios. We'll go to the worst drawdown statistics. The worst drawdown for QQQ recently, the last drawdown was 35%. The market went down by 35%. It started 12.27 and ended on recovered on 12.13. 2021 12.27, which is around here, 2021 12.27, close to 2022, and it regained in 2023 around this time, 2023 12.13. So it took around close to 5-13 years to regain from that minus 35% net drawdown. Worst drawdown statistics of 2 times leveraged, it's 63%, which is close to 35. This is 70%, it's 63%, and it hasn't recovered yet. Because of this extra leverage, QQQ has to go much higher to just recover its 33% drawdown. So imagine if you had invested in the portfolio at the peak time. At this time, you are still waiting for it to recover. So that's the reason taking extreme leverage is more riskier than just investing in non-leveraged ETF. Similarly, the net drawdowns are much longer. So for example, we'll take another drawdown, the fourth drawdown, the 73. It recovered in 73 days, and this one took 77 days. It naturally takes more number of days than the non-leveraged fund to recover. So you have to be extra patient to recover your losses in a leveraged funds versus the non-leveraged funds like QQQ. In this case, the second worst drawdown was 22.79%. Took 163 days to recover. This one 42%, which is double of this one, close to double. And then it took 226 days to recover. 163 days and 26. That's about the drawdown. We went through the cumulative returns, so I'll skip that. All of this we'll skip. And annual returns are multiplied by the leveraged amount compared to the non-levered ETF. For example, this one, QQQ. QQQ was somewhere around 40, 50, 60%. Double that one is close to 110, 120% in 2023. Now we'll switch to the covariance analysis. You could go to the covariance analysis in the portfolios page, the covariance analysis. But to get there, you'll click on portfolios, click on the fund, then it shows the covariance analysis. And here we just want to see the correlation metrics. Since it's the same asset class, you see the correlation is close to 1. You look at the correlation, it's close to 1 because it's the same asset. So QLD and QQQ have the same correlation. So if QQQ goes down, QLD, TQQ will also go down. And QQQ if goes up, the other ones also will go up. But we have to multiply the magnitude by the leverage times. That's the correlation metrics. With that, I'll close today's session. If you have any questions or comments, please reach me out in the YouTube channel or in the discussion tab in the documentation page.